may be pre-recorded.
The Word on Wealth with Gary Quackenbush is sponsored by the Word on Wealth Radio Network. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary is a San Diego financial solutions attorney protecting people like you. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future.
Monday Live-age.
Monday Live-age. Welcome to the Word on Wealth. Happy Monday, everybody. It's so good to have you along. What a great start to the week. I hope you're all having a great week. I hope you're finding joy in your journey and figuring out what you, kind of what you think is most important in life. This past weekend, I actually went to a memorial service for my father-in-law, and that was quite touching. And I was talking to Noah before the show started about how I feel about it. I mean, I get sad, but I'm very much inspired. I mean, there are things that I've written in my journals over the weekend. Those of you who've been listening to the show for a while, you know I journal. I write in my journal every day. I write in a gratitude journal and a regular journal. And when I have experiences like I did over the weekend, I write a lot more. And I will be adding to those things because he was an amazing guy. The things he did throughout his life to serve other people and to have people at the memorial service come up and say, oh my gosh, he was such an incredible guy and he helped me with this and he helped me with that. That's the kind of stuff that makes me just look out and go, Gary, step it up. Let's do
Makes
this.
You want to be a better person.
Absolutely better person. Committed, totally committed. I have it in my journal. He was a happy guy. I mean, he worked really hard. His ethic was just hard work, and hard work overcomes everything. All your problems can be, and he was just so inspirational. I love it. He was a great, humble guy, wasn't flamboyant, never tooted his own horn. And we're finding out a lot about him reading through his journal and his little black books. So it's super cool. So yeah, I'm gonna be a better person because of Alan. So that was my weekend. So I'm glad the week's getting started. And here on the Word on Wealth, our goal is to teach you how to deal with your estate plan. Every one of us has an estate. Absolutely every person. California, we're trying to for sure reach.
It's funny, Gary, and it's really a misconception. And I bring it up at the beginning of the show because I find it really important. I thought for a number of years before I started working with Marty and now working with you, well, I don't own a home, so I don't have an estate. And I think that's a big misconception that still exists out there today. Big misconception. In fact, I was just talking to my son not an hour ago, and he was saying, Dad, I'm upping my life insurance. How much should I get? And he owns a home. He's got some money put away and he's working on a retirement plan. He's got 4 kids. And I was talking about insurance. I said, part of life insurance is when you don't have a big enough estate, you don't have enough wealth that if you die and you don't have, things built up, the life insurance just creates this estate, and I think that's what insurance is all about. And someday, like I told my son, Matt, I said, someday you'll have enough money put away that life insurance won't make sense. Like at my age, it doesn't make sense because the premium's too high, to get $1 million of life insurance when you're 40 and in good health and you don't drink and don't smoke and, you live a good life, and they do all the tests and they go, wow, the paramedic comes and says, okay, for $1 million life insurance, you have to have a medical exam. And they look at it and go, oh yeah. So you're, live a clean lifestyle, all that stuff, life insurance, it's just not very expensive at all for even $1 million policy. When you get to be my age, even though, I don't drink or smoke and I exercise regularly and all my numbers are great, you still look at it and they go, well, you do risky behaviors like ride mountain bikes and climb rocks, so they charge me more money. But it's just like I don't need it anymore because I have I don't need life insurance to pay off my debts and things like that, like I did. So, but everybody has an estate, and if you don't have one, then you don't realize you do, because everything you have, your clothing, your car. I was just going to ask. That's the follow-up question. What,
Gary,
constitutes as an estate?
Everything, Noah. It's your car, your bicycle, your household goods, your personal property. The more typical is like a home or a rental, or it could be your life insurance proceeds. It could be
cash
your
assets,
retirement account, cash assets. Yeah. Intangibles. You can own patents, trademarks, copyrights, your investments, your stock portfolio, your money management stuff. All that is your estate. So everything you have that is of value is your estate. So the plan, the estate plan, is to figure out what to do with that, the stuff. We'll just say your stuff there's stuff that has value and there's stuff that's important but doesn't have value. All that is part of your estate plan. And what we typically think about with an estate plan is you think about, okay, when I die, then my estate plan does its thing. And that's really not the way I set them up. My estate plans that I set up say, if I became incapacitated, then this is what happens to my stuff. This is the person that is in charge, helping me manage my money, spending my money in the right place, taking care of my health care and my needs. That's
let's put it out there again, Gary, because I didn't realize this until you started bringing it up. How many people actually become incapacitated during their lifetime? So that's why what you're about to say is why things should be set up in this manner.
Oh, 70%.
Wow.
No, 70% of Americans become incapacitated before they die. And the number is actually 70% become incapacitated for 90 days or more. And they know that because if you have like disability insurance, they figure, if you become disabled, usually your insurance won't kick in for 90 days. So they know exactly how many how much they have to pay out. So they look, and it's 70%. It's a very, very big number. And what that means, Noah, is if you become incapacitated, we're defining it legally. And that is, you do not have the legal ability to make a contract or make a contractual type decision. It means you can't buy something, you can't write checks, you can't go to the bank and transact your normal business stuff, the stuff that you do every day. And you don't realize how much stuff you do every day, over the period of like a month's time. You don't realize how much you as an individual do until you have someone pass away and you are taking care of their stuff. Then you start to realize, wow, there's a lot of decisions to make. You have utilities and insurances and things that are being repaired or taken care of, and who's the person who's mowing the lawn, who's washing the windows, all these different things. You do a lot. And if somebody has to substitute for you and do your job while you're incapacitated for more than 90 days, you're not going to be able to do without mowing the lawn or paying the utilities or paying.
So what happens if you have some of these plans that are set up? I don't know how much of this you see if people come from the other side of it, where it's not originally set up to where if they become incapacitated, does that leave somebody up a creek?
Yes, because somebody has to take care of them. I mean, and I know this will sound odd, but it's even worse than having that person pass away, because when you pass away, you don't need to spend any more money. You don't need utilities. You don't need rent. You don't need gas, because you've died. If you're incapacitated, you need all those things. You need to pay your rent or mortgage. You got to pay for utilities to take care of things. So during incapacity, you are alive. You have the need for money, sometimes even more than pre-incapacity. And so you have to have somebody take care of it for you. If you don't have a living trust, or that the whole setup with living trust and power of attorneys and the things to set up like a complete estate plan, then potentially what happens, Noah, is that somebody would have to go to court and get a conservatorship over you, because the conservator then is like a power of attorney that was appointed by a court because the person that needed the power of attorney did not have the capacity to assign somebody.
And how hard is that process to get through once, things are set up incorrectly, your family member becomes incapacitated? Mm-hmm. How hard is it to go back and do it the other way, the correct way?
Oh, if the person, has their capacity, like if we were doing it for you, Noah, it's easy. It's just part of the estate plan.
No. I mean, so let's say who I originally set it up with
mm-hmm.
didn't do it for having that incapacity,
right?
And I become incapacitated, and now things are kind of up a creek.
Oh, now
you say you have to go to court for the conservatorship. Yeah. How hard is that process?
It's very difficult. I mean, it's mostly expensive and time consuming. And usually, I mean, even if we're in a hurry, it'll take us at least 3 months, sometimes 4 months to get it. So now you have that period of time when nobody can spend money for you. And what happens is your kids, the people that care about you, people are fronting money. They're, the kids are swiping their cards, swiping as in using them. The kids are, if you have kids that are watching out for you, they're trying to pay the bills and trying to, to make sure the lights don't get shut off and the house isn't taken and the car and whatever. So you have people, usually family members, people that love you, are kind of fronting money now until they can get a conservatorship. But I mean, we do lots of conservatorships, and
2 minutes.
by the time you get them done, it usually is at least a 3-month process, if not more. It's just a very complicated
Well, and again, it could be
process.
more because the people are living their daily lives, and it's hard to make appointments work with the people that are going to be helping you out with this. That's why I think having people like yourself do it in the correct manner, that's so important.
I totally agree. And that's what, that's my life mission. It has been for 30 plus years. So if you guys, you're my listeners, if you want help with this, 855-500-TRUST, 855-500-TRUST. We give free consultations to all of our listeners. You just call and mention the show. Say, hey, I heard Gary on the radio today, and I want to set up a consultation. I want to talk to him about my estate plan. I'll review your old one that you've got. I'll help you set up a new one. We'll talk about all of your options available. It's 855-500-TRUST. Happy to do it for you guys. One of the things I want to make sure that we get over, and I'm going to
1 minute,
kind of our follow through on this thing. What I'm going to do is I talked about the Secure Act. The last couple times, I think, last week, a couple different times I talked about the Secure Act and how it changed. I was just doing some research over the weekend about the Secure Act again, and some of the changes that are coming down. There's been some proposed regulations to interpret the Secure Act, and I want to explain how that works. It's a little frustrating, but at least I want to talk you through it so you'll be aware of it, so that when your tax professional says, hey, you should have done this and should have done that, they may be right. So coming up next, we're going to talk about the Secure Act, a couple things that came up fairly recently with some regulations. This is Gary Quackenbush on the Word on Wealth.
You've got questions. We've got answers. This
I think that turned out pretty good.
with Gary. You peace of mind with expert estate planning.
Yeah, I got to get mine done. Once I'm waiting for once can.
So Gary, we've talked a long time about estate administration. So what is that? And why is it important?
Estate administration is the distribution part.
I'll be here before you know it, dude. A month and a half, I'm going to be married.
That's
Crazy.
minister. So it's like taking it from the decedent to the survivor. That's called the estate administration process. So usually,
Yeah, you'll be getting the invite probably. We're going to try and send the official
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855-500-TRUST.
Monday Live is.
so I will tell you about the Secure Act. What happened at the end of 2019 is there was an act, federal, that came out, and it was called the Secure Act. It's an acronym for something. It has nothing to do with anything being secure. I think part of
Yeah,
it
that's
is-
good. Mostly because it's not, right, Gary?
it's because it's like any other act or bill that goes through. There's
So
one
true.
part that people like, and then
It's the
rest
opposite of what they
just
say it
stuff.
is.
Yes. And the act, and that they're really good about titling things to make it sound like it's really great. I mean, the whole idea with secure is it's just an acronym having to do with something to do with retirement accounts. So what happened, the basics of the Secure Act were that prior to the Secure Act, if you inherited an IRA or inherited any retirement account, IRA, 401k, 403b, you would receive that as the beneficiary. You would receive it as an inherited IRA. Okay. An inherited IRA is different than an IRA or a 401k or 403b. It's inherited. That changes the tax consequence. Once it's inherited, the organization that was hanging on to it, the custodian, they will send it to the beneficiary and they will code it and notify the IRS that an IRA or a 401k or 403b just got transferred to the beneficiary recipient, and it is now an inherited IRA. And now the IRS will watch and count how many years you have to do certain things. Okay, so originally it would be if you, for example, inherit an IRA from your father, and then you would have to start taking out required minimum distributions the year after you got it, regardless of how old you are. And then, which would mean the required minimum distribution means you have to draw something out of that account. The money has not been taxed, right? You inherit it, it's not taxed. It was never even taxed by your dad. He put it in before it was taxed. So it has not seen the tax light of day. And the IRS wants to make sure that it does. What will happen is every time you take money out, it will be taxed because it'll go on your income tax return, reported as an income distribution out of your retirement account. Okay, so with this, it used to be that you would receive money and then you would take it out over the rest of your life expectancy. Under the Secure Act, they reduced that to 10 years. The big thing that's been really messing people up is the regulation came out, the act passed in 2019. That means it has been in effect for 2020 and 2021. We are in the middle, we're getting to the third quarter of 2022. Well, the IRS came out and said, well, wait a minute. People that inherited an IRA and the person that was receiving the money, the decedent, if they were required to take required minimum distributions, which means they were, 70 and a half, and we were having to take out their own required minimum distributions based on their life. If they were taking those out before they died, and now you inherit that money, you're required to take out this thing called the at least as much as rule, which means, and this is a weird interpretation, but so what you would do is you should have taken out during the 10 years, which would now be 2020 and 2021, as least as much as you would have under the old law, which the IRS is suggesting now that you should have taken out based on the chart. So if you're 60 years old when you receive that inherited IRA, they're going to look at a chart and say, okay, 60-year-old is going to live to 84. So you need to take out 1/24 because you have 24 more years of life. That's basically how the charts work. Don't hold me to that. And then if you're 61, they're going to say, oh, well, you only have 23 years left. So you have to take out 1/23. So during the first 9 years, years 1, 2, 3, 4, 5, 6, 7, 8, 9 of, the post-death period, you're supposed to take out at least as much as you would have taken out under the old rule. So it's like do a required minimum distribution like the old rule. So that's the way they're interpreting it now. And that's as of May. So, we're a few months into it. We're still kind of doing that, but it's not become permanent yet. And that's the frustrating part. So what most tax professionals are doing is they're saying, well, go back on 2020 and 2021 and take distributions of at least as much as you would have had to have taken under the old law. Take it out, put it on your tax return, pay the taxes on it, and just deal with it. And then if you do that for 20 and 21 and now 22, then you're going to be okay. Okay. Now, because it's the Secure Act, that means for years 1, 2, 3, 4, 5, 6, 7, 8, 9, you're supposed to take out at least as much as you would have taken out under the old rule. Then before the end of year 10, you have to take out everything else. So no matter what, you're going to take it all out. The way you look at it is you meet with your or your financial professional and say, how can I best take this out? Should I take it all out now? Should I take it out in the next 2 years? So you got to look at these as least as much as rules. And then you got to look at the 10-year rule to make sure you're going to take it out in time. If you don't get it all out, if you don't take it all as a distribution before the 10th year, whatever you should have taken out, you're going to be penalized 50%. So if you got $200,000 and now you've only taken out, $50,000 and now it's year 11, the IRS is going to they're going to say, well, that the 150 that you didn't take out, we're penalizing you $75,000. And good luck trying to get out from under it. It's not possible. So you're going to have to pay this 50% penalty for undistributed money. So that's the thing with the Secure Act. So if your tax professional says, yeah, you maybe should have taken out a required minimum distribution for 20 and 21, you might want to consider doing that. That's your tax professional and your call on that to make sure. I just want you to be aware that if that comes down, if your tax professional is bugging you about doing that, it's probably because they're up on the law and they're up on what's changing. So to be up on the law is interesting because the law is changing, but they're doing the best they can. So just watch out for those. Inherited IRAs are different than the old ones. The other thing to watch out for is Proposition 19. Jordan Marks, the taxpayer advocate of San Diego County, assessor recorder's office, has explained how Prop 19 works. Now, Prop 19 has been in effect for a couple of years. It went into effect, was it in the beginning of 2019? I think it was. Was it? Yeah. And what it does is it makes it so that if you inherit property from your parent and that property was your parents' primary residence, and now you make it your primary residence, then the portion that you inherited, you can exempt from an increase in property taxes. So if it's a single only child, the parents have a house, it was their primary residence, they die, they will it or put it in their trust to their child, that's a parent to child exclusion, and it applies because that child moves into the house and makes it their primary residence. Okay. If the child makes it a rental, it does not apply. They're going to reassess the taxes, the property taxes based on fair market value. Period. Jordan Marks says there's no way to change that. What they're doing is they're trying to get it so that inherited property taxes are high, are like up to fair market value. They don't like this thing where it stays down forever. And you can pass it on and pass it on and pass it on. They're getting rid of that. The other thing that happens with Prop 19 is if it's anything else, it's not a principal residence, it's a rental, it's a commercial property, it's a duplex, it's the half of the duplex that you didn't live in. If you're not in there, your person does not live in there, and then the child that's inheriting the property doesn't move in, it's just reassessed. That means that property taxes are going to go, the value of the property is going to go to fair market value, and you're going to pay taxes based on the fair market value. For some people, that's devastating. You have to factor that into how much you're collecting in rents. You're going to factor it into your net profit. A lot of people, though, with rents right now in San Diego, they're like, whatever, I'm making less money, but I got to pay the taxes. And the thing is, it's not like you have a choice. What people are doing, and this is, I want you to be cautious. If you're suspicious or if you suspect this may have happened in your situation, call me, 855-500-TRUST, 855-500-TRUST. And let's go over this, because what the county assessor is doing is they're looking to see people that inherited property and didn't show that it was inherited, didn't redeed the property, didn't take care of the stuff they're supposed to. And they're looking to see when the transfers occurred, and they're going and they're back charging you. So sometimes you have people where they're going to be in the property for a couple of years and they just forgot to tell anybody. Well, that property taxes were supposed to have gone up that right after the person passed away, it gets reassessed. And it didn't. So now the assessor's looking at it going, hey, you knew that after death, it should step up. You didn't tell us till 3 years later, we figured it out. Then they're going to go back and assess these penalties because of your failure to tell them. So when a person passes away, the process that we go through is called trust administration. So the trust or the estate plan has to be administered. You can't just let it sit. You can't let mom and dad pass away and then just live in their house and drive their cars and all that. You're going to have problems with insurance. You're going to have problems with loans, if there are any, and you're going to have problems with property taxes. So don't do that. If if the property is supposed to transfer to beneficiaries, transfer to heirs, it needs to be transferred. The probate code says it has to be done within a reasonable time. So if you're the successor trustee, you're the one charged with doing that. Like you whip out your dad's trust, mom passed away, dad passed away. You look at the trust and go, whoa, I'm the successor trustee. I don't know what to do. Do you really think that's a legal excuse? It's not. It's not a legal excuse that, the government's not going to say, oh, you didn't know any better. That's okay. We're not going to reassess your taxes, or we're not going to, make you file a tax return or pay a tax or whatever. Of course, they're going to make you. And they don't really care that you didn't know the law. And why would you know the law? I mean, before I learned this stuff as an attorney, most attorneys don't even know this stuff. It's just there are laws that apply to people that have property in California. I mean, household goods, personal property, anything. When people die in California, there are certain laws that govern and control the distribution of property, and that needs to be done. So that's one of the things you got to work on. If you need help with trust administration, if you need help and you want to have some questions like, are you doing it right? Are you being a good successor trustee, or are you not doing your job because you don't know what you're doing? You don't know how to do it. You don't know what to do. Give us a call. Don't wait too long.
2 minutes.
Don't wait until you get sued by your sibling or a beneficiary that says, hey, why haven't I heard anything? You don't want to do that. Call me at 855-500-TRUST, 855-500-TRUST. The purpose of this show is to teach this stuff and to have the opportunity later to get into detail. If you want to talk about it, I'm happy to do that. We are finding a big rise in the number of people who are inheriting property and people that are inheriting a lot of property. The problem is that people are not taking care of business. They're acting as the trustee and they're just saying, oh, well, it's just me and my two siblings. We're just going to split everything in thirds. Well, that's not the way it works. You got creditors, you got the Department of Health Services. There's other things you got to watch out for. So be careful and do your job right. Don't think that you know what you're doing if you've never done it before. Most of us have never been a successor trustee before. And as a result, you don't know what you're doing. California law requires that you delegate responsibilities for which you are not qualified. One thing you are not qualified for is to be a successor trustee. So you got to delegate the responsibility. To who, you ask? Great question. Well, the legal stuff to a lawyer, the tax stuff to a tax professional. If there's financial advice that needs to be had, don't look it up on the internet. Don't search it on Google and say, I am an expert. Get a financial professional to help you out. And I'm glad you listened to the show so we can help you out with this. And our financial professional, by the way, is here every Thursday. That's Anthony Wright. This is Gary Quackenbush on the Word on Wealth. Coming up next, if you have a tax problem, like you owe money to the government, is there a thing you can do about it? Or do you just stick your head in the sand? Don't do that. Listen up to the show. We're going to talk about how to resolve tax problems right after this little short pause.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush of GQ Law. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST. Call Gary at 500 Trust. GQLaw.com.
Right. Hey, welcome back, everybody. This is Gary Quackenbush, and it is Monday. So today's tax problem solving day, as most of you know by listening to the show. Hey, Rich, how you doing?
Good, Gary. Great to be here again.
Yeah. So Rich comes in. He works with our firm. The two of us work for GQ Law. We're the two attorneys that we make things happen, whatever that is, right? But so Rich is in charge of the tax legal department, which has anything to do with taxes and kind of the legal implications of taxes, which usually means not like the actual tax preparation, although our firm does take care of that kind of stuff. It's what happens if there's something that didn't go quite right with your taxes. And one of the things that Rich has been working on lately, which to me is, I'm just so glad that he's the one doing that, is dealing with audits. And so I brought Rich on. He's on a regular guest with us on Mondays, and I wanted him to talk a little bit about, like, Rich, what is an audit? I mean, is that something that's terrifying? How does the IRS tell you about it? I mean, is it something that people should be really worried about, or should they get help? Can you talk a little bit about, like, what's an audit? How does that all work?
Well, an audit is generally where the IRS, either through just a random process, or if their computers flag something in your tax return where they want to review with a specific examiner to go over a particular year or a couple of years, maybe, about questions that they have. There are 3 types of audits. I think we've mentioned this in the past. There's the correspondence audit, which is the easiest one, where they send you a letter asking for questions or asking you to provide additional documents. Second one is the office audit, where you would go to the IRS office and meet with the examiner there. Then the third one, which is a little bit more serious, is the field audit, where they would come out to your place of business and go over and request records. So, there are the 3 types of audits.
That would be I just remember somebody telling me that, he was involved in an audit and he was trying to kind of avoid the thing. And it was like this auditor was saying they wanted to come out, but it was, he just kind of didn't want to deal with it. And the IRS really wanted to come out and see him and visit him. And the reason they did that, because that would be considered a field audit, is usually field audits are businesses, right? I mean, they don't necessarily go to somebody's home and say, let me look through your file cabinets, but they do that with businesses. And I just thought it was interesting. This particular person I was dealing with is like, why did you try to ignore it? Because they're not going to, if you don't respond to them, they're not just going to go away and say, oh, okay, well, never mind, he's not responding to us. They're still going to do the audit.
Yeah, definitely don't ignore it. Usually whoever filed your taxes should be there. And it probably would be a good idea to have a lawyer there so you can, make sure that your legal rights are protected, but make sure that, the IRS's document request is reasonable and that you provide them the information. I have seen cases where the clients either didn't respond at all or gave the IRS just a bunch of, stuff that really wasn't responsive to the audit request. So, and then the IRS kind of threw the book at them. So I would highly recommend that you make sure to deal with it and have your tax preparer and probably your lawyer with you, especially for those field audits.
So let's talk about then, if somebody goes through the audit process, they get their notice and it says, we wanted to look at your tax return, call this number. And usually the person will call the number, and it's more like it's a scheduler. It's not the actual auditor. They schedule a time for either you to go in the IRS field office, or they're going to come out to your office. So they schedule that all up. So let's say then that happens, and for whatever reason, the audit just doesn't go their way. I mean, they look at the numbers. The IRS provides this report and it just shows they're disallowing expenses, they're adding income, they've, added in different bank accounts. I mean, is there hope at that point, or you just got to kind of like go, oh my gosh, the IRS caught me and what do I do?
There, you can appeal the examiner's audit determination, and then it would go into appeals. if you cannot resolve things through the appeal process. The appeals is a specific office within the IRS that they sort of, I wouldn't say they are on the side of the IRS or on the side of the taxpayer. They're sort of a neutral party that tries to resolve it, as an intermediary between the two parties. If you can't resolve it through the IRS appeals avenue, then you would probably file what's called a tax court petition with the U.S. tax court. That's where you definitely would need our services, because you need to be a lawyer to file a case with the U.S. tax court. You have to have you file it through their online software system, and you have to have a authorization. You have to get a certification to file those cases, and then you would file.
That's when you're getting serious, right? Tax court.
Yeah.
So to get to that point, it's what the IRS is doing is you'll have gone through this audit and provided paperwork and maybe had some legal arguments or whatever, or not. Maybe you didn't provide anything, but the IRS gets to a point where they're actually sending a letter that says, hey, we examined your return and this is what we found. Or they could be saying, we tried to examine your return and you never answered the phone, you never showed up. And so here's what we've decided. In other words, here's what we found. We found that we're disallowing all of your deductions, your business expenses, your utilities, whatever for your business. And we're disallowing, or we found something we're going to add. But what you're saying then is as long as you're dealing with it, if you dislike the results, you go to this appeals department. So Rich, when you get to appeals, let's say it's the IRS appeals department. So are they looking back through all the paperwork again, or are they rethinking, or what's the process that's going on at that point?
I think they're supposed to look at new information that you would provide. I mean, they do have access to whatever was provided to the audit examiner. So, but I've taken on a case, and the IRS disallowed like maybe 500 expenses, and then added like maybe 500 income lines to the taxpayers' 2 years of returns. It was just kind of an overwhelming situation. But what I did was I had the client, we had the client organized by each category, and kind of narrowly tailored it so that the appeals office could look at it and say, this in this category, this is our backup for this section. For this category of expenses, these are our receipts for this one. And so we really organized it so that the appeals office could look at it, and understand where the auditor was coming from and where the taxpayer was coming from. And then we had a call the other day, and we went through each category, and it's kind of it's a give and take type of thing. You're not going to get everything you want probably, but if you can get, I think we could get like 60-70% reduction in what the IRS was claiming through the audit exam. So, it's a give and take, but I was proud of myself. I did a sort of a back and forth, and the client got a little bit testy, and the appeals officer was a little bit harried, but we kind of worked on things, and I think we're going to reach a settlement. So we aren't going to have to go to tax court.
So it seems like, it's not like the end of the world. I mean, audits they're awful. I mean, somebody's actually coming in and saying, hey, we don't believe you. We're disallowing this or disallowing that. A lot of audits for businesses are just a big deal. There's businesses, as most of you know, is when you file your business tax return, you have business deductions for advertisement, for utilities, for fuel, for whatever. And sometimes there's a question of whether a particular deduction is actually a business expense, or whether it's kind of a hidden personal expense and you're using it, for a non-business purpose. So with business audits, you tend to get there's a lot of records, there's a lot of issues, and sometimes there's argument as to whether a particular thing is deductible or not. And that's the kind of stuff when you get into appeals, you're dealing with the appeal officer on whether the auditor was right, because the auditor is saying, no, this is not deductible. And then you may get an appeal officer that looks at it and says, well, actually it is, because here's a certain rule or a case or something. So the one thing I want to shift to like personal. So we get personal audits, and you had mentioned a correspondence audit. So if the IRS correspondence audit, meaning the IRS sends correspondence. By the way, let me just tell you, I know we've been going for a while, but if you want help with this, mention the show and just say you want to talk to us about an audit or an appeal. The number is 855-500-TRUST. That's our main line, 855-500-TRUST. That's GQ Law. That's the company. That's the law firm that's supporting this radio station, this radio broadcast. So 855-500-TRUST. Okay, so when you get a correspondence audit, that means the IRS has sent you correspondence. Are they looking for everything, or do they pick one or two things and say, prove this, prove that?
I think generally on a correspondence audit, it's probably more specific and, narrowly tailored because, that's probably the easiest and simplest. And they think they can handle it through the mail and just letters to the taxpayer. So I don't think it's going to be, everything like they might hit a business where they're challenging almost every category or every expense deduction or lack of proof of income, things like that. But so I say correspondence audit might be a little bit more narrowly tailored.
And then on a correspondence audit, so let's go to this is kind of where this is where Rich and I usually get brought in. We don't typically, as attorneys, we're typically not on the very start of the audit process. That's usually for your tax professional and you're trying to struggle through that, or maybe you're working on your own. I don't know. But usually where Rich gets brought in as a tax attorney and a tax court attorney is when things didn't go quite right. So what happens sometimes is we'll get a correspondence audit. And then if the client just doesn't respond at all, then the IRS just assumes they're right. So a lot of times what will happen, for example, you'll receive like 1099 income because maybe you did some work for somebody and they paid you $500 and they sent the IRS a 1099. Or maybe you got some gambling winnings and the casino says, yeah, here's your gambling winnings. They report it to the IRS. There's, or you had a mortgage interest deduction that's reported to the IRS. All those things are reported. So typically in a correspondence audit, it's the IRS is looking for, they didn't find those things on your tax return. But man, a lot of times you can go back to the tax return and go, wait a minute, these are all on there. It's just that there were several different entries and you think you got them all right. And if we can go through and show line by line that, yes, it really was included, and sometimes it's tricky, but if you can show it really was included, then the IRS will give up and they'll say, oh, you're right. We include, it was included, or maybe we'll have to say, well, half of it was included or not. But sometimes it's a matter of explaining because the tax return didn't quite show it right. Is that about right, Rich?
Sounds right. Yes.
Okay. I'm talking a lot. 855-500-TRUST is the number to get in with us to talk to Rich about an audit or a tax problem that you've been dealing with, whether it's payment plans or that type of thing. Coming up next, what I'm going to ask Rich is, if you do owe taxes, if you do owe it, you can't pay them, you can't just like write a check. I want to ask Rich, is there something that can actually be done? We're going to talk about that coming up next here on The Word on Wealth.
You've got questions. We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQLaw.com.
We're with Craig Smith of Borderland, your local source for cybersecurity. And Greg, what are you seeing today in terms of ransomware attacks?
Well, employers of all sizes are wondering which employee will it be? Who will be the one that clicks on that phishing email that brings my company to its knees with ransomware? Clicking on what seems like a safe email can allow hackers to load viruses, steal your passwords, and watch what you type, ultimately stealing data. And once this data has been extracted and backups encrypted, ransomware shuts down one computer at a time in your business. And by then, it's just too late.
So, Craig, how can you help?
Well, our team, our local guys at Borderland, educate your staff. They use state-of-the-art hacker training programs, and we set a perimeter around your business. Don't be shut down by hackers. Protect yourself for only a few dollars a month per employee.
Call Borderland right now at 855-945-8100 and get a free consultation and quick quote on software services that help protect you and your small business. That's Borderland, 855-945-8100.
We look forward to protecting you.
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law. 500 Trust. Or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com. 855-500.
You're live.
Hi, welcome back to Word on Wealth. This is Gary Quackenbush and Rich Maturin. We're both attorneys with GQ Law. So what if you do have a tax problem, or every time you get together with your cousin, they're always talking about, oh man, that old IRS are after me, and I don't know if they took my bank account again. Rich, are there any solutions if somebody owes money to the IRS and they just can't pay it?
Yes, there are a number of options, and we generally would ask you to come in, and we would probably recommend running a tax report to kind of see what you owe and what years were filed or not filed. When your might fall off under the statute of limitation, your balances might fall off under the statute of limitation. If your balances might be eligible for a bankruptcy discharge, it'd be dischargeable under bankruptcy laws. But so there are a number of ways you can fight it, like we talked about earlier, with the appeals, or possibly fighting it through the Chapter 13 bankruptcy laws. Or we can get you into there are several payment type options. One obviously is to get into an installment agreement where you full pay your balance over a number of months. One good thing about that is the interest rate is halved, and also collection activity is stopped while you're in that payment plan. If you can't afford a full payment plan or a full payoff, we can possibly get you into a partial pay installment agreement where you would pay off, a part of your balance. That's based on your financial ability to pay. Another possibility, which is, I think, very misleading in the press, is the offer and compromise program. There's certain circumstances for people that do qualify for the offer. You can't be able to pay full pay under an installment agreement, and you can't have assets like large equity in home or retirement. But if you don't have those things, an offer might be an option. That's a formula-based thing where your offer is based on your equity and assets and your net income times 12. So it is kind of a calculation. It isn't just, I have $1,000 that I have in my wallet that I can offer to the IRS to settle my balance in full. It's based on your actual financial circumstances.
Not quite that simple, huh?
Yeah.
So we can't just tell the IRS, here, I got an extra 20, let me send it in, and they won't forgive your liability.
I just think that's so misleading for some of the advertisements you see on television where they're saying that you can just they'll wipe out your tax balance for pennies on the dollar. It could be pennies on the dollar, but again, it's based on your current financial circumstances.
And there are 100 pennies in a dollar, so I guess technically, yeah. So if you get, like, let's say you got into a payment plan, I mean, the penalties, I know the penalties are pretty high, especially if you've waited. And we just noticed, we got that news from the IRS today. They just increased the interest rate on past due taxes to 6%, which is, it used to be like 2, now it's 6. So if you set up a payment plan and you do it formally, official payment plan, getting that interest rate cut in half, that's a big deal, especially if you're paying on it for 3 or 4 or 5 years.
3%. And if your first year penalties, we could get those removed under what's called a first time penalty abatement. But you have to, it's the first year that you incurred penalties. If you had prior year penalties the last 3 years prior to that first one, then you wouldn't be eligible. But you can get a first time penalty abatement and then subsequent ones. But again, there's sort of rules for that first time penalty abatement to be applicable to you. One other option that I would mention, I think that a lot of people overlook or are fearful of, is bankruptcy. We can discharge taxes as long as they were due 3 years prior to the bankruptcy filing, filed by the taxpayer within 2 years of the bankruptcy filing, and assessed by the IRS 240 days before the bankruptcy filing. They have to have been, the tax return has to have been originally filed by the taxpayer. They can't be like a substitute return that the taxpayer either didn't replace or replaced later. Those are not dischargeable in a bankruptcy.
So, and that kind of stuff you can find out. Rich has this report that we actually have. Because we're practitioners, we have a software program that lets us access your tax records, and that would require us to get a power of attorney. and lets us log in, get records, and literally go back. We can go back, what, 10, 15, 20 years sometimes
I
on
think
that
it's
stuff?
30 right now. It's not till 1990.
We can find out more about you than you ever wanted to know. Interesting. But I think a lot of people don't know that. And by the way, for you listeners, we have a book. It's online, gqlaw.com. The book is called The Tax Bankruptcy. It's got an orange book cover. It's a picture of a lion head trying to eat someone. And we're saying that the IRS is the lion, and the lion tamer is probably Rich there with his chair and his whip. But it's called The Tax Bankruptcy. It talks about discharging taxes in bankruptcy, like what it takes, and whether your taxes would qualify, and about tax problem solving. It's free. Just go on our website, gqlaw.com, GQ like Gary Quackenbush, law.com. And it's on every page of the website. So orange, you click on the cover. It's the book cover that has like a lion head on it. Click on that, put in your first name, email address, and the book will be sent to you. And that'll help you understand the tax bankruptcy, getting rid of it. And like Rich said, it still surprises me how few people understand that bankruptcy can be a powerful option. Rich, thanks for being on the air with us again today. Really, really appreciate it.
Great to be here. Thanks. I enjoyed it.
All right. 855-500-TRUST. You want to get an appointment with Rich, talk about your tax problem? 855-500-TRUST. Coming up tomorrow, we will be back talking about more estate planning. We're done with the Secure Act, but we're going to move on to what should you really have? Is a living trust really for you? That's coming up tomorrow on the Word on Wealth. Bye, everybody.
Tell a friend about the Word on Wealth, featured since 1995 with financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help you preserve your family's financial future. The information you hear on the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The opinions expressed here do not necessarily represent the